Hello everyone, welcome to the 124th episode of me learning how to trade in Forex. So in the last episode we went through the 5 deadly O's of trading, what traders do to guarantee their own failure. So the 5 factors are overconfidence, overtrading, overleveraging, overexposure, and overriding your stop losses. So went through what each of the factors mean. So overconfidence, inflated belief in one's own trading skills. Overconfidence effect is a cognitive bias in which someone believes subjectively that his or her judgment is better or more reliable than it objectively is. Overconfidence is observed in 3 distinct forms: overestimation, overprecision, overplacement. Overestimation is a tendency to overestimate one's performance. Overprecision is the excessive confidence that one knows the truth, and overplacement is a judgment of your performance compared to another. To minimize the effects of overconfidence, you must take time to truly understand yourself and what you're capable of achieving. You must be aware of your limitations and what opportunities are not worth pursuing. And most importantly, you must always consider the possibilities that you are wrong and that you're open to new suggestions and be able to change your mind. So yeah, we went through overtrading, including revenge trading. Overtrading is when you trade too frequently, taking extreme large trades, and or taking uncalculated risks. Successful traders are extremely patient. So what matters is protecting your capital when you trade. So they'll wait until the odds are more in their favor before entering, and you will know if you're overtrading. So yeah, that's overtrading. Revenge trading, basically letting your emotions get into you regarding your trading performance. So when it comes to trading, you must trade using your head and not with your heart. So revenge trading is basically when you suffer a large loss or a series of losses within a short time span, and then you want to get back at the market by keep trading just to see if you can make the profit back. That's revenge trading. When you start doing that, your state of mind is not objective anymore. And then we went through some ways to avoid revenge trading. So be fully present and fully focused whilst trading. Have a good state of mind and not filled with negative emotions, and have a trading plan and stick to it. So yeah, don't stress over one loss. You need to look at the long term when being a trader. Over leveraging, basically using too much leverage, which could lead to you magnifying your losses and quickly blowing your account. So at the beginning, it is recommended somewhere, I think, to start trading with no leverage as new traders, and then adds a bit more leverage when you're confident enough, and when you're knowledgeable enough to know when to add more leverage, basically, because the higher leverage, the greater your risk on each trade, likely resulting in irrational decision making. Profitability declines substantially as true leverage increases, and yeah, use a true leverage of 10 to 1 or lower. Having access to high leverage doesn't mean you need to use it, and yeah, new traders try starting with zero leverage. And overexposure, this is the bit when we talked about having positions in different currency pairs and then thinking that you're diversifying your risk, but you really aren't, because some pairs are correlated with each other. So placing one trade in one currency pair and placing another trade in another currency pair when they're correlated is basically like doubling up on your risk. That's known as overexposure. You need to understand the concept of currency correlation. And yeah, overriding stops, basically you need to have the mental toughness and the self-control to stick to your stop losses. If your stop loss is hit, that's your trade over. It means your trade idea was invalid, and you don't ever move your stop loss. You don't ever remove your stop loss. You don't ever move it somewhere else. You don't ever shift it. So yeah, do not override or remove your stop and let it ride, hoping that your the price is going to go into your direction and you might make a profit instead. But no, just close out your trade. If the market hits your planned stop, then your trade is done. Donezo, over. Widening a stop is basically like not having a stop at all and doesn't make any sense to do it. So that's the 5 O's for trading. And now we're on to how to lose all the money in your trading accounts in 10 days or less. So, how to lose all the money in your trading account in 10 days or less. Date is the 3rd. Whoa. So, do you want to learn how to make all the money you just deposited into your trading account quickly vanish in 10 days or less? Here's a step-by-step guide. Buy a super expensive computer. Don't forget to buy at least 6 27-inch Ultra HD 8K monitors and mount them all on a magnificent monitor stand so that you can watch your price charts along with the CNBC, Bloomberg TV, Fox News, Fox Business News, Reuters TV and Cheddar all at the same time. You need all this stuff in order to trade successfully. Don't forget about the luxury ergonomic chair from Herman Miller that perfectly aligns with your spine's natural curve. Once you've bought them all, watch your account balance in your trading account explode with profits. That gigantic electricity bill due to all your gadgets will look like spare change. I'm assuming this is all sarcastic, by the way. So, step 2. Focus on trying to find the perfect technical indicator. So, all this steps is just basically what you shouldn't do. Once you find this mystical technical indicator, it will be like installing an ATM machine to your kitchen. Trade big, no scratch that, trade huge. Your 6 Ultra HD 8K computer monitors will all glow bright green due to all the positive pips. Step 3. When your technical indicator says that the currency pair is oversold, buy it right then and there. Always do what your chart indicator says to do. Never ever question it, like ever. It's always right, like always. Doesn't matter if important news is coming out or if price action is telling you something different. Your puny brain is no match for the indicator. Step 4. Don't pay attention to the current or future economic outlook of the world's biggest countries. Who cares about the global economy and geopolitics? Schmonomy, that stuff is boring. All you have to do is stare at your charts all day long until a winning trade magically appears. Trading is really just a staring contest between you and the market. Whoever blinks first loses, so make sure you concentrate and stare long and hard at your charts. Who cares if your eyes start bleeding? Ignore that, push through it, it's just eye bloods. Eventually profits will appear, it's really that easy. Step 5. Make sure to visit a bunch of Forex trading forums and go through all the threads until you find hot trading tips. If you don't find any hot trading tips, then private message total strangers for Forex trading tips and ask them for some. The less you know about them, the better. It's more mysterious that way, and makes trading fun. These tips are free gifts and will make you fabulously wealthy in no time. If you're really lucky, you may even find people posting about the magical technical indicators, or EAs with 137% win rates that you can download for free. Step 6. Read what other traders are doing and be sure to follow them without question. Following other traders is a no-brainer. You literally need no brain to do it, so your puny brain needs not worry. Just blindly copy their trades. According to their profiles, these folks have been trading a lot longer than you, which means they definitely must know what they're doing, right? Why am I even asking a question? That requires thinking. Just go ahead and start copying random trades already. The sooner you start, the faster you'll be able to achieve that perfect Instagram lifestyle. Step 7. Skip creating a trading plan. If you see a good trade, just do it. You shouldn't argue with Nike, even if their slogan is meant for athletes, not traders. Just do it, victory is yours. Forget about developing a trading plan, don't worry about how or when you're going to exit. Never mind the details, the trade is guaranteed to win. It will be a slam dunk. Step 8. Dream about how much you'll make, not about how much you'll lose. Don't worry about proper position sizing. Who cares about how much you can lose on a trade and how much you'd need to make back just to return back to break even. Just think about how much you can win. Then find directions to the nearest Ferrari dealership or Hermes store. Step 9. Don't set stop losses. That's for losers. You're a winner. You win at everything. All you do is win. Just like DJ Khaled. We're the best trades. You proclaim. Stop losses are for losers. Even if your trade is currently in the red and losing, you know it eventually turn around. Unlike everybody else, all your trades always end up as winners. Don't worry about your trade blinking red on your screen. Just like how age is just a number, red is just a color. Step 10. Make trades based on your emotions. No need for logic, simply rely on consistently dependable emotions. When you're excited and feel greedy, you buy, or when you're scared, you panic and sell. Trading emotionally is how you will pile up winning trade after winning trade. At least that's how you feel. Final tips. Make sure to perform as many of the steps as possible. Pretty soon, you'll be seeing that big fat zero under your account balance that you've always dreamed about. If you're lucky, you might even see a negative balance. If you're really impatient and want to lose money even faster, feel free to repeat any of the individual steps vigorously. But if you want to avoid blowing your trading account in 10 days or less, now you know what not to do. A lot of traders have made these mistakes when they first start trading, including myself. Hopefully you don't follow in my footsteps. So don't buy an expensive computer. Don't focus on trying to find the perfect technical indicator. Don't buy straight away when your technical indicator says that the currency pair is oversold. Pay attention to the current or future economic outlook of the world's biggest countries. Don't do that. Don't visit a bunch of Forex trading forums and go through all the threads until you find hot trading tips. Don't read what other traders are doing and follow them without question. Create a trading plan and follow it. Think about how much you'll lose, not how much you'll win. Set stop losses. Don't make trades based on your emotions. So that's the 10 tips. 10 tips to avoid blowing your account. Don't buy a super expensive computer setup. Don't focus on trying to find the perfect technical indicator. Don't buy straight away when your technical indicator says the currency pair is oversold. Pay attention to the current or future economic outlook of the world's biggest countries. Don't go on Forex trading forums to find hot trading tips. Don't follow what other traders are doing without questioning it. Create a trading plan and stick to it. Think about how much you'll lose, not how much you'll win. Set stop losses and Don't make trades based on your emotions. Okay. Tips for Forex trading beginners. As a beginner, you've taken your first steps towards learning the basics of Forex trading, but it only gets harder from here. Just like learning how to walk, you have to take baby steps, and in between you will fall, but you get back up and press forwards. If you're trying your hand at Forex trading for the first time, know that the most beginner traders are best served by keeping things simple. Know that most beginner traders are best served by keeping things simple. Here are some tips every trader should keep in mind before trading currencies. Keep things simple as a beginner trader. Forex trading tips. Educate yourself. We can't emphasize enough the importance of educating yourself and learning as much as you can about the Forex market. Finding quality Forex education sources like the School of Pipsology. Before risking real money, make sure to study the different currency pairs and understand what makes their prices go up and down. Educate yourself. Learn as much as possible regarding the Forex market. Find quality Forex education sources. Study the different currency pairs and understand what makes them go up or down, what makes their prices, not them, what makes their prices go up or down. Create a plan and stick to the plan. Trading plan and stick to it. You are the most rational before placing a trade and most irrational during your trade. You are the most rational before placing the trade and most irrational during the trade. This is why you need to always have a plan prior to opening a position. Always have a plan prior to opening a position. Creating a trading plan is a crucial component of successful trading. A trading plan is an organized approach to executing a trading system that you develop based on your market analysis and outlook, while factoring in risk management and personal psychology. A trading plan is an organized approach to executing a trading system that you've developed based on your market analysis and outlook, while factoring in risk management and personal psychology. With a trading plan, you're able to know if you're headed in the right direction. You have a framework to measure your trading performance, which you'll be able to monitor continually. This allows you to trade with less emotions and stress. Trading plan enables you to trade with less stress by letting you know if you're heading in the right direction and have a framework to measure your performance. Continually. 3. Practice. In real life, you may have a plan to drive from point A to point B if you don't know how to wait. In real life, you may have a plan to drive from point A to point B. If you don't know how to drive the car that will get you there, then your plan is futile. The same applies to your trading plan. You should test drive your trading plan first until you become proficient in executing the plan. You should test your trading plan first until you're proficient in executing the trading plan. It is important to learn how to use the features of a trading platform before you start trading on it. Ensure you know how to use the features of a trading platform before you start trading on it. Fortunately, traders can test out each platform using a demo account, which means no real money is at risk. Demo account allows you to put your trading plan to test in real market conditions without risking any real money. Always practice using a demo account. Keep it slow and steady. One key to trading is consistency. All traders have lost money, but if you maintain a positive edge, you will have a better chance of staying profitable. Educating yourself and creating a trading plan is good, but the real test is sticking to that plan through hardcore discipline. A trading plan is only effective if it's followed. You have to stick with it. Stick to your trading plan. Consistency is key for trading. Know your limits. As a new trader, you have to know your limits. First of all, do you have enough money to trade? Forex will not make you rich quickly. So make sure that the money you'll be putting at risk, called risk capital, is money that you can actually lose. If you need that money to pay the bills, then you should think twice about trading. If you do have the money, then you need to know how much you're willing to risk on each trade, sticking with leverage ratios within those risk limits, and never opening position size that's so big that it could blow your account. A lot of traders fail because they don't understand trading with margin and ignore the effects of leverage. They shouldn't be you. I shouldn't have used so much leverage, now we're homeless. Ensure the money you'll be putting at risk is money you can afford to lose. If you do have money, then you need to know how much you're willing to risk on each trade. You need to know how much you're willing to risk on each trade. Sticking with leverage ratios within those risk limits. Stick within those limits and never open a position size that's too big, which could blow your account. A lot of traders fail because they don't understand trading margin and ignore the effects of leverage. This shouldn't be you. Keeping your emotions in check. To become consistently profitable, you have to stay rational and emotionally detached. You need to stay rational and emotionally detached. Many novice traders ride an emotional roller coaster, feeling on top of the world after a win, but down in the dumps after a loss. In contrast, most experienced traders stay calm and relaxed even after a series of losses. They don't let the natural ups and downs of trading affect them emotionally. Don't fall prey to the most dangerous emotion in trading: greed. Emotional stability matched with proper risk management is the name of the game. You need to stay rational and emotionally detached. Don't be greedy. Emotional stability and proper risk management is the goal. Stay open-minded. While having discipline is a very important trait for a trader, you also have to be wary that if you're too stuck in your ways, you'll end up imposing our ideas on what the market should do, instead of reacting to what is actually happening. Constantly question the market and your trading plan. Constantly question and your trading plan. Asking questions enables you to look at different perspectives of the market that you initially may not be aware of. This practice will make you think of other potential scenarios that may emerge and enable you to become a better listener of the markets, rather than an imposer of your own thoughts and views that in reality may not mean zilch to the market. Look at the different aspects of the market. Listen to the market instead of imposing your own thoughts and views, when in reality may mean nothing to the market. What makes a good trader? What separates good traders from bad traders? A good trader realizes that trading is patience, discipline, and requires a trading approach that adapts to their specific psychological profile. A good trader concentrates on the process of trading and not just on the results. Here's a list of other things that good traders do. Trading is patience, discipline, requires a trading approach adapted to a specific psychological profile. So, requires patience and discipline. Trading requires a trading approach traders require a trading approach adapted to their specific psychological profile. Concentrate on the process of trading and not just the result. Here's a list of other things that good traders do. What good traders do. A good trader knows if they have sufficient risk capital in order to achieve their financial objectives. You should know if you have sufficient risk capital to achieve their financial objectives. Sufficient risk capital in order to achieve their financial objectives. So, if you have enough money that you're willing to trade, which you can afford to lose, to achieve your financial objectives. Good trader always acts according to their own judgment. They think for themselves rather than be blindly influenced by others. You should act according to your own judgment and think for yourself. Rather than being blindly influenced by others. A good trader never trades on hope. They analyze the market and take calculated risks. Never trade on hope. Analyze the market and take calculated risks. A good trader stays out of the market when in doubt. So if you're not sure regarding a trade, then just don't do it at all. Stay out of the trade when in doubt. Good traders do not chase the market. They wait for signals to appear based on their market analysis and trading strategy. Does not chase the market. So I think this means like don't force like trading opportunities to appear. So if you're looking at like candlesticks patterns, for example, say that it's like a 3 in a row candlestick patterns, I forgot what they're called, but which one was it? Yeah, so one of these, say if like one of the candles isn't exactly as it should be, but then you think, oh, you know what, it's similar enough, then it's similar enough and it still works, so I'll still trade it. Don't do that. If it's not, if it isn't as it is, well, it doesn't even make any sense. Just if you're unsure about it, just don't do it. That's what I want to say. Stay out of trade when doubts. Good does not chase the market. Wait for signals to appear based on their market analysis trading strategy. Don't chase the market. Wait for signals to appear based on your market analysis and trading strategy. Does not overtrade. Don't overtrade. So don't place too many orders at the same. Oh no, don't place too many orders, and don't revenge trade. I'm guessing as well. That includes in there revenge trading. Good traders does not fight against the trend. While they may trade pullbacks or counter trend swings, they are aware that this price movement is temporary. Don't fight against the trend. They may trade pullbacks or counter trend swings, but they are aware that it's only temporary. Good trader always knows the reward to risk ratio. Always know the reward to risk ratio of each trade. A good trader cuts their losses instead of hoping that the trade will turn around. So know to cut your losses when instead of hoping that the trade will turn around. Good trader allows their profits to run until an exit signal based on their trading strategy triggered. Allow your profit to run until an exit signal based on your trading strategy is triggered. Good trader always analyze their closed trades to find any lessons on how they can improve. Always analyze your closed trades to find areas of improvement. And to find areas of improvement. Good trader is patient and knows that there are periods when they don't need to trade. Be patient for opportunities and know that there are periods which you don't need to trade. A good trader never widens the stop loss. Never widen your stop loss. Good trader never cancels a stop loss. Never remove your stop loss. Good trader treats each trade separately. Treat each trade separately. Good trader exits the market when in doubt. Exits the market when in doubt. See, this is an interesting one because aren't you meant to trade not of your emotions though? But in doubt is an emotion though, isn't it? So how can you exit the trade if you're in doubt? Unless your trading plan tells you to exit the trade, then you shouldn't exit the trade, right? Exit. Oh, exit the market when in doubt. Oh, so that means just don't even place trades at all. So if you're not sure about whether there's like an opportunity for a trade in this market, then just don't trade in that market at all. Right, I see. Right. Exit the market when in doubt. Good traders not blindly follow the advice of others. Don't blindly follow the advice of others. So this is all the factors of what good traders does. Factors which make a good good trader, which make a trader good. So trading requires patience and discipline. So this should be know if you have sufficient risk capital to achieve you should act according to your own judgment and think for yourself rather than being blindly influenced by others. So this is already oops. So this is already repeated at the bottom. Don't blindly follow the advice of others, but whatever. Never trade on hope. Analyze the market and take calculated risks. Stay out of trade when in doubt. Don't chase the market. Factors which make a trader good. Be patient. This should be patient and disciplined. Have a trading approach adapted to your specific psychological profile. Concentrate on the process of trading and not just the result. Know if you have sufficient risk capital to achieve your financial objectives. Act according to your own judgment and think for yourself rather than analyze the market and take calculated risks. Stay out of the trade when in doubt. Don't chase the market, wait for signals to appear. Don't overtrade. Don't fight against the trends. You may trade pullbacks or counter trading swings, but you are aware that it's only temporary. Always know the risk to reward ratio of each trade. Know to cut your losses instead of hoping that the trade will turn around. Allow your profit to run until an exit signal based on your trading strategy is triggered. Always analyze your close trades and find areas of improvement. Be patient for opportunities and know that there are periods which you don't need to trade. Never widen your stop loss. Never remove your stop loss. Is there an always have a stop loss? Always have a stop loss. Always have a stop loss. Treat each trade separately. Exit the market when in doubt. Don't blindly follow the advice of others. Okay. That's that. Very good. So, I think I'm going to leave this episode here then. We finished off the most common trading mistakes new traders make. So yeah, and now in the next video we're going to carry on to Forex trading scams with Forex managed accounts. So thank you for watching. Bye.